Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending July 16, 2021. So this week, again, I will be recording this solo. Our chief economist, Magignac, is still on vacation, and last week, for extraordinary reasons, we were unable to record a weekly economic review. So expect this one to be a bit longer because there are some themes from last week that we really wanted to cover this week. But I'll start with the economy and then follow through with the impact on financial markets. But before, let's look at the market action this week. So positive for bonds, as you can see on top. So 0.66% on the week for the long index, and year to date still red for the bond market. But remember that at some point this year we're at minus 12% year to date on the long index. So we kind of have moved back 50% of the way towards zero, but we're still experiencing a negative year, of course, for the bond market. Equities this week, it was negative in North America and positive elsewhere around the world. Minus 0.2 for the S&P 500, all the way to plus 2% for emerging markets. But when you bring everything back in Canadian dollars, because the Canadian dollar was under pressure this week, and if remember, when the Canadian dollar pulls back, that favors your foreign investment when you bring everything back in Canadian dollars. So everything turns positive, except of course the TSX, which was the lone negative when you bring everything back in Canadian dollar on the week. Year to date, the TSX remains ahead, but with a very slight margin now over the S&P 500. Also, the other markets, the price of oil was negative on the week. An agreement between Saudi Arabia and the United Arab Emirates on oil production, raising oil production a little bit. So technical elements, but still some pressure on the price of oil, which is close to $72 now. Canadian dollar negative, euro negative, and the price of gold, after having a very tough stretch lately, is slowly coming back. Another gain, 1.17% on the week, but still negative year to date. So COVID now, as usual, the chart on the left now, we present the share of population that is fully vaccinated, so 2 doses. Canada, we are number 4 here, behind Israel, Great Britain, and the US. But look at the slope of the curve for Canada. So it's really still going up like this. Is the red dotted curve. So we are making a lot of progress. And I think I mentioned that 2 weeks ago, that at the pace that we were going in Canada, probably by the month of August, the share of the Canadian population that would have been fully vaccinated would be ahead of the US. Well, we're almost there, 45.9% for Canada fully vaccinated versus 47.7% in the US. So probably, and I say probably, next week when we discuss again, we should be ahead of the US if the pace continues. But we have lost our number 1 rank. Now Chile is doing an even better job at vaccinating than Canada, so we're number 2, but still we're very close to Chile. All right, so economy now. So the theme here is that we are clearly seeing peak growth around the world. So it's not peak economic. It's not that, well, the expansion is done and we're going to be faltering again. That was just the pace has been so strong recently that now it's starting to come down a little bit, but from very, very elevated levels. So it's not a bad thing. If you look at the economy, it's completely normal. It was to be expected. And Q2 will be the high water mark for growth. We'll have growth that will be stellar for Q2 around the world. And then it's going to slowly come down to something that is more natural toward the end of the year or early 2022. This is completely normal. We always see that at the beginning of a business cycle, but it does have a very important impact on investor psychology, and we'll be delving into that in a few minutes. But here, if you look at the economic surprises index in the US, after being very, very elevated, we are now below zero. So again, firms like Bloomberg, for every index that comes out on a daily basis around the world, they survey forecasters and they have a consensus. And if the number is above the consensus, well, that's a positive surprise. So this line goes up. And if it's below the consensus, well, the line goes, it's a negative surprise and the line goes down. And now we are below zero. So that means that we've had a lot of negative surprises recently, and it's not that the data has been bad. It's just that expectations have become so elevated that now it's hard for the data to beat the expectations. So it's a kind of a game of cat and mouse, but it's normal to see something like this at this stage of the business cycle. So we'll talk about the impact on investor psychology, but we need to talk inflation first because we had inflation data this week, and we also had Mr. Powell's, the Fed's Mr. Powell testimony before the finance committees at the Senate and the Congress. And he did address inflation, and he's staying the course. Inflation should be transitory. Our question here, my question that I'm asking is, yes, transitory, but for how long? So is it going to be shorter than they expect, longer than they expect? We are in the camp that it could be transitory, but probably it's going to be transitory for longer than we think. There seems to be a consensus between both the Fed and the Bank of Canada that summer 2022 we should be back to target on inflation. We're still thinking that inflationary pressures could linger a bit later on, but we're not seeing inflation of 4, 5, 6% for a long time. We'll be tapering down at some point on the inflation figures, but we could be find ourselves where it's sticky between 2.5 and 3.5%, something like that. So this is our house view here in the economic team at IA. But here the chart on the left is the U.S. core inflation figures at 4.5. The total inflation was at 5. And here what it shows is that, well, you could argue that it's temporary. One important argument for it being temporary is that if you exclude new and used cars, instead of having 4.5, you have 3%. So you know that some factories were closed to produce cars because it was hard to get chips. COVID made also a situation dire, so some factories just closed. So now there's a shortage of some models. It's hard to get a car. So what do? Well, if you can get a new car, you're going to buy a used car. So prices of used cars are going up. Prices of new cars also are going up because it's hard to get them. So if you want one, you need to pay up. Also, the economy is reopening. If you needed to change your car, well, now is a good time to buy one. So putting pressures on used cars and on some parts too, because of the chip shortages and everything. So this is, of course, a phenomenon that everyone knows that's going to be temporary. How long, I don't know, but it's going to be temporary. But it's one argument for the transitory higher inflation rate. On the right, this is from the Bank of Canada's monetary policy report that was published this week. Mr. McClem referenced that a few times in his press conference, seeing that there are some factors at play here, and you have all of the details in the chart here. Commodity prices are pushing higher. Other factors is everything related to the price pressure coming from the new rules of following COVID, the social distanciation and all of that. So they expect inflationary pressure that will subside in mid-2022. And then after that, as the economy will be growing quite solidly, let's say, they expect inflation to slowly grind up all the way to 2.5 because the economy is going to be very strong. So they expect a temporary burst in inflation all the way to 4%, then back to neutral in 2022, and then inflationary pressure higher than that. So this is kind of the views of the world from central banks. We don't completely disagree with them, but we do see a risk factor that this goes on longer than expected. And then how will central banks act and how will the markets react to that? That's still a very open question. Bank of Canada still eyeing strong growth ahead, but Mr. McClem himself said that QE is still needed. So it's not our opinion, it's his opinion that is there. On the left, you see that the forecast is very, very strong for growth over the next few years, all the way to 2023. The line is pretty steep, so that's a very strong growth. The red line is the latest projection. The blue line is the one from April. So as you can see, they even upgraded their forecast for a few years forward. And on the right, you have all of the details. Just want to focus on the GDP line. They expect 6% this year instead of 6.5 in April. So they downgraded 2021 a little bit, but they upgraded 2022 quite a bit, meaning that we end up higher after a few years than what was expected. Final domestic demand, so everything that is domestic like everything that happens in Canada should be stronger than they expected for 2021 and 2022. And inflation should be on average 3% in 2021 and 2.4% in 2022. So as you can see, all the way to 2023, this inflation is being above their target. So we'll see if it does come down as they expect, or if it's more sticky, let's say, towards the 3% level. So last week we had the jobs report. I didn't get a chance to address that with you, so I thought I'd bring it here. So the third wave of COVID was wiped away in one fell swoop. So remember that for April and May, we had negative job prints in Canada. So we took a few steps back because of the restrictions from the third wave of COVID. But now in June, we kind of erased all of that. So that was a very strong signal. 89% of the lost jobs have been regained versus 70% in the US. So we're still doing much better in Canada than in the US. And on the left, look at these charts here. It's the comparison to the previous recessions. So we're kind of in line with the rebound from 2008. And remember that 2008 was not as bad for Canada than elsewhere in the world. So we're pretty much in line with this recovery, but we're way above the 1981 recovery and the 1990 recovery. Remember, in the 1990s, it took close to 5 years for the labor market to get back to pre-recession levels. So we are still doing very well here on this chapter. And one last thing on the jobs report. Usually when you look at the jobs report, you judge whether it's a good one or a weak one. First, you look at the headline. Is the headline good? And after that, the details, you look, well, is it mostly services? If it's mostly services, you say, well, it's not that strong. And if it's mostly part-time, you say, well, it's not that strong either. But now we should look at things differently. On the left, you see that the rebound of employment since February 2020 is more than complete in what they call other sectors. So the economic sectors that have not been impacted by COVID. So we're above where we were. So there's more people working in sectors that were not touched by COVID than before, even though the economic recovery is not full yet. So that's a very strong labor market that we have. But the sectors that were impacted, so trade, accommodation, food services, culture, recreation. So those are the jobs where you go to restaurants, you go to museums. So those are the jobs where they're still the workers are still behind, still hurting, and this is where the recovery is operating itself now. So it's mostly services. It's there's a lot of part-time work there, so it's going to be completely normal if over the next few months the labor report have a strong headline and the details are a lot of part-time and a lot of services. That's completely normal. That's not a sign of weakness. It's just a different way of looking at the jobs reports over the next few months as we are recovering in these sectors, because on the right you see the recovery has been pretty uneven, and now those are the sectors that are benefiting. So you're going to have a lot of jobs creation, lots of part-time, lots of services, and the average wage figures are going to be pulled down by the composition of the sectors that will be creating jobs. But still, that doesn't mean that it's weak. It's actually pretty good, pretty normal, and pretty strong. So now moving to the financial markets. So here, Mr. Powell on Wednesday and Thursday was laser focused on his message. So staying the course, meaning inflation is transitory. They are opening the door to being wrong on that, which is a good thing. They say that the next 6 months will be critical for inflation and their understanding of inflation dynamics. So they say that maybe they are wrong, that inflation is as transitory as they think. So we'll see, and we respect that point of view from them. And he did say that the Fed is still a ways off from altering policy. So we wanted to make sure not to make waves in the markets. And here on the left, you have the 5-year government bond yield. So the CPI when it came out on Tuesday was stronger than expected, so it pushed interest rates higher. As you can see, when Mr. Powell started talking, it brought interest rates pretty much back to where they were. So that's mission accomplished for him, not making any waves in the market. So when will the Fed start tapering its QE? Many were expecting Jackson Hole in Jackson Hole symposium in late August. It's getting less likely, looking at the language that was used by Mr. Powell. So there's some uncertainty there, but good job by Mr. Powell of staying the course and making sure not to create any waves in the markets. So now looking at Wall Street, so this is Q2 earnings season that just started. On the left, you have the number of companies reporting each day of each week. So we just started. We just ended the week of the 15. Look at the next 3 weeks. This is where most of the reporting will take place. So we'll have a better view at earnings growth in the next 3 weeks. And on the right, this is the expectations, how the expectations for earnings growth have changed for each of these 4 target quarters since July of 2020. So over the last year, analysts have been revising their forecasts. So they upgraded the earnings expectations for Q3 of 2020, Q4 of 2020 by 3.6 and 2.4%. Analysts were looking at Q1 and Q2 of 2021 as being strong, but look at Q2 2021, the expectations now are very, very, very high. So we should have very strong numbers. That's not an issue. The question that we're wondering now is what will be market psychology? Will we just punish those who miss the estimates and not cheer, meaning pushing the price of their shares higher for companies that beat expectations, because we're kind of a top peak growth environment starting to settle in. So it's a risk that even if the numbers are strong, they might not be strong enough to the liking of investors. So this is one thing that we are cautious about over the next earnings season. And here we had the global fund manager survey being published last week. Investors are expecting peak earnings. So on the left, you see the profit expectations. They're starting to turn around. And this is normal at the beginning of a business cycle. So usually you have some euphoria and then you see peak earnings and they start to fall down. So we'll see if it happens. And on the right, the inflation expectations have fallen drastically too. So we see now investors are looking at things. They say, well, probably things are as good as they're going to get in the short term for profits. This is on the left. And the markets are also rallying to the view of the Fed that inflation is very temporary. So again, 2 risk factors that we think are important here. We could have surprises to the upside on inflation, just shaking the beliefs of investors. And we're very curious to see how investors will be reacting to the earnings that will be announced. So maybe the last chart here, peak growth, what does that mean for the stock market? Well, peak growth means short-term volatility and not market peak. And I can't stress this enough. This is a very important chart that I'm presenting here that I got from the Wall Street Journal. So at the beginning of each cycle, at some point, you reach peak growth, meaning peak ISM manufacturing index. So that means that the pace of growth at some point, it accelerates. At some point, it needs to fall down and to converge towards its long-term rate of growth. So it's not that it's no more growth anymore. It's just that growth can stay at 10% forever. So when you start to see that, the peaking of the speed of the economy, you tend to see the market consolidating. You tend to see the market being volatile in the short term, as you can see from the line underneath both of these gray circles that you have there. But then after some consolidation, sometimes you can have a correction. You can never time these. But after that, you do have the stocks that are starting to rise again. So earnings will continue to grow, just not as fast. And the economic news will continue to be good, but just not as good. And then you'll have some more growth on the stock market. So history tells us that in the short term, you could be in for some volatility when it's a peak growth environment, but that doesn't mean that this is the peak of the stock market. Not at all. There's many more good quarters ahead of us for the stock market. So what to watch next week? Canada will have retail sales for June. May was negative because of the 3rd wave of COVID, so we should have a positive rebound there. In the US, we'll have housing starts, the manufacturing and services PMIs. So all of these figures here are at very elevated level. They could come down a little bit because of peak growth, but that doesn't mean that we would have bad figures. It just means that we are slowly falling back towards something that is more sustainable. So that wraps it up for the week. If you want to follow us, ia.ca/economy is your go-to website. Everything we write, everything we record, we post there. If you haven't done so already, you can subscribe to our newsletter by entering your email address in the mailbox there. Again, as we mentioned many times this year, if you want to have a PDF copy of this presentation, just write at economics@ia.ca and we'll send that to you gladly. So thank you everyone for your support. We will be back next week, of course, with another edition. I can't confirm if Mr. Gignac will be with me or not because vacation season is upon us, but we will be here to keep you informed next week. So thank you very much. Enjoy the summer, and I'll be back next Friday with another edition of the Weekly Economic Review.